You may or may not have heard of a thing called a bucket company or an investment company. It's just another tax structure about how and where to hold your investments. Is it the right one for you? Well, it depends. I'll give you some tips today and then definitely happy to have a chat around that, whether that suits for you or not. So what is a bucket company and how does it work? Let me take you through some of that. I'm Martin McGrath from Financial Edge Group, and we specialise in helping people with complex financial affairs get their retirement sorted. A bucket company is one of the structures that we often see with clients in this space. So a bucket company is a tax structure. It's a company structure. Many of the clients who have bucket companies for us actually ran businesses and perhaps previously had trading companies. It's a little bit different. It's an investment company. So it's still a company. It has to do a company tax return. It pays company tax, but it probably doesn't have the GST. We're not employing employees and having PAYG and super payments, those kind of things, purely through an investment lens. Why some of the reasons we like to use bucket companies is they have a flat tax rate. The tax rate for a bucket company is 30%. You pay 30% on the first dollar and you keep paying 30% whether it makes $500,000, $1 million or 10 million. It doesn't go up and it doesn't go down. Now, if we're only making 10 grand a year, well, 30% is a pretty high tax bracket. But as individuals or beneficiaries of a family trust, if you earn above $200,000, you're up at the 47% tax bracket. So 30% starts to feel pretty attractive if we're in this space where we're getting some big income. Now, I'm talking about investment income, but in theory, some of this might apply also to business income or consulting income. It depends. We need to discuss that. I'll stay in the investment space for now. So, flat 30% company tax rate. So, whether that's better than your current structure or not, or other opportunities, super obviously is fairly attractive at 15%, but there's a limit how much we can get in there. 30% often is the next best flat rate of tax. Number two, it has what I like to call a tap. We can take the money out of there or we can not take the money out of there. You get to decide or we get to decide based upon year-on-year situations. So when I'm saying taking it out, it depends who the beneficiaries are. And if in a year that you might have some money in a bucket company and you've got some personal rental properties, if it's a year you've made a massive capital gain, we may not decide to pay any income or shares out of the bucket company that year because your tax rate's already pretty high. If you're in a family trust or the investment's in your own name, you can't decide. It just has to flow through. Whereas a bucket company, we can say this year we're not going to pay dividends. Next year we'll pay dividends again. Actually, this year we can pay some big dividends because all the other income's gone out. We can turn that tap on, we can turn it off, we can decide how much it flows out and how much it doesn't. But there's ways there where we can control how much comes out or doesn't come out. Number three, potentially is who that goes to. If I'm investing in my name, the income has to come to me. With a bucket company, it goes to who the shareholders are. So we can have more than one shareholder, we can have many shareholders, we can have different types of shares so that certain dividends go to certain individuals. We can also use a bucket company and a family trust together so that potentially we can flow different dividends out to different individuals each year. So it's not a set beneficiary, whereas if it's in your personal name, it has to come to an individual. To a bucket company with the other structures around, you can control where and how that money kind of flows through. I'll give you the fourth before I excitingly finish with the fifth positive. The fourth, I suppose, is potentially a negative. One of the downsides of a bucket company is it doesn't get the 50% capital gains discount. If you're investing personally, a joint, through a family trust, if you hold some shares or property and have a capital gain, you often get a 50% discount. So instead of paying tax on 100,000, you've only got to pay tax on 50. In the bucket company, you'd have to pay tax on 100. But it's only at 30%, so it might be 30,000. If you've got a capital gain, it's 50, tax is at 47, it's 23.5. So there is a difference, but it's not potentially as significant as people think. And depending on, we often might structure certain investments in the bucket company, perhaps they're less high growth and more income generating, and more high growth assets elsewhere to get some CGT discount. So it is important to remember that there are some disadvantages. Like many things in life, there are positives and negatives. There are some negatives that come with it, but with the right planning, we can nullify those negatives. The fifth one I like about bucket companies is that if and when the bucket company does pay tax, it's made 100 grand in income in the bucket company, it pays tax to 30,000, we physically have to pay that tax. But versus say personal tax, we've paid that, the tax is gone. Versus in a bucket company, you get what's called a franking credit or a tax credit, which is basically an IOU. Like when you get some shares from ASX companies, they come with a franking credit, which means that when you get that money later, you don't have to pay as much tax. Now, it might be that it ends up in a beneficiary at 47%, 30% credit, they've still got to pay some top-up tax. But if that beneficiary is at 30% as well, there might not be any tax. If that beneficiary is actually below the tax rate of 30%, and there are definitely cases and scenarios we're helping clients with this now, not only not paying tax out of the bucket company, in some cases they're getting tax back because of the franking credits. So not only is the tax rate potentially a bit lower, but it's tax that potentially could actually be coming back later in various sources. Hopefully that gives you some insight to bucket company. Is it right for you? It depends. Typically not if it's $50,000 invested, $100,000, probably even $500,000. The complexity, the accounting costs that come with it probably don't make sense. But if we're in the millions and substantial millions, it's very likely something we should be looking at and potentially have in place. If you want to have a chat further, feel free to get in touch with us at financialleadership.com.au.